Most people compare SGOV and money market funds the wrong way. They start with yield. Which one pays more? Which one's safer? Which one's better right now? But that's usually not the real question. The real question is, what job is this cash supposed to do? Because emergency fund cash has a different job than tax reserve cash. Cash for a down payment has a different job than cash you're keeping on the sidelines for your next investment move. Once you see that the whole SGOV versus money market debate starts to look different, this isn't really about squeezing out a little extra yield. It's about setting up your cash in a way that actually works in real life. And if you get that set up wrong, even the better option on paper can still be the wrong move. So let's break this down the way people actually should. Not just yield, not just convenience, but function, taxes, flexibility, and the part a lot of people skip over: behavior. Because when it comes to cash, the best option isn't the one that wins on a spreadsheet. It's the one that does its job when you need it to. At a basic level, SGOV is an ETF that holds very short-term US Treasury bills. A money market fund is more like a cash vehicle inside your brokerage account. It's built to feel stable, simple, and easy to use. So even though people tend to throw them into the same bucket, they're not doing the exact same job. They may both be places to park cash, but they solve that problem in different ways. Money market funds usually win on ease of use. SGOV usually gets attention for treasury exposure, possible state tax advantages, and a setup that can make more sense for certain types of idle cash. So this isn't really a good versus bad comparison. It's more like two solid tools that start to feel very different once you actually use them. The biggest mistake people make here is using one number to make the whole decision. Usually that number is yield. They see one option paying a little more, and that's basically the end of the story. But cash is different from long-term investing. With long-term investing, you can live with short-term noise because the money has time to do its thing. Cash is different. Cash has a job. And the more specific that job is, the less sense it makes to choose based on yield alone. Ask yourself, is this emergency money? Is this money for upcoming bills or taxes? Is this dry powder? Is this short-term savings I might need soon? Because if the answer changes, the best home for that cash can change too. That's why, which one is better is actually the wrong question. The better question is, which one is better for this kind of cash? Now, let's start with where money market funds usually make more sense. The biggest advantage is convenience. For a lot of people, they're just easier. They feel stable. They're easy to understand. They usually fit neatly into the brokerage experience. And that steady $1 share price matters more than people like to admit. Not because it magically makes the investment better, but because it makes the whole thing feel like cash. And that matters. If this money is truly operational, meaning you may need to move it, spend it, or mentally treat it like ready-to-go cash, then convenience is not some small side benefit. It's a major feature. If this is money for near-term expenses or part of your emergency fund that you want to feel simple and accessible, a money market fund can be a really strong choice. In that case, the goal is not to squeeze every last drop of efficiency out of it. The goal is to keep the system clean, stable, and easy to live with. A lot of people get too cute with cash. They chase a little extra yield, add complexity they don't actually need, and end up with a setup that looks smarter than it feels. And when cash starts feeling clunky, that's usually a sign the system got worse, not better. Now let's talk about where SGOV starts to look better. SGOV gives you direct exposure to very short-term treasury bills in a simple ETF wrapper. For a lot of investors, that's appealing. It feels more intentional. It feels more transparent. And if you already manage most of your financial life inside a brokerage account, SGOV can feel like a natural fit. This is especially true if the cash is not really day-to-day money. Maybe it's a larger cash reserve. Maybe it's dry powder. Maybe it's part of an emergency fund you don't expect to touch often. Maybe it's money sitting between investment decisions. In those situations, SGOV can make a lot of sense. Not because it's some magic fix. Not because it's perfect. But because it gives you a very specific kind of exposure that some investors genuinely prefer. Short-term treasuries, low duration, and a vehicle that trades easily in a brokerage account. For a lot of people, that feels cleaner than using a generic sweep option or a money market fund they barely think about. So no, that doesn't mean SGOV automatically wins. But it does mean it solves a slightly different problem. Money market funds tend to solve for ease. SGOV often solves for control. This is also where taxes start to matter, and this is one of the biggest things people miss. A lot of investors compare the quoted yield on SGOV to the quoted yield on a money market fund and assume that tells them everything they need to know. It doesn't. What matters is what you actually keep after taxes. Depending on where you live, that can shift the comparison more than people expect. Treasury income can get more favorable state tax treatment than some money market alternatives, which means the option with the slightly lower headline yield can sometimes come out ahead after taxes. That doesn't mean SGOV always wins. It doesn't. The details matter. Your state matters. The fund matters. Your account type matters. But that's the whole point. A lot of people stop the analysis way too early. They look at the top-line yield, call it a day, and never ask what the real after-tax outcome looks like. That's why this topic keeps coming back. Once you stop looking at yield in a vacuum, the comparison gets a lot more interesting. Now for the part a lot of one-sided videos tend to gloss over. SGOV still trades like an ETF. That changes the user experience. With a money market fund, your cash mostly just sits there and behaves the way people expect cash to behave. With SGOV, you're buying and selling shares. It's not hard, but it is different. There's market structure behind it. There's pricing behavior involved. There's a little more friction. For some investors, that's not a big deal at all. For others, it matters more than they expected. And this especially matters if the cash is supposed to feel instantly usable. Because emergency cash is not just about technical liquidity. It's about behavioral liquidity too. In other words, will this setup still feel easy and dependable when life gets messy? Will you still like it when you're stressed, distracted, or dealing with an actual emergency? That's the real test. A lot of people tell themselves, well, it's liquid, so I'm good. Maybe. But the better question is whether it still feels like real reserve cash when you actually need it. If the setup makes you hesitate, second guess, or feel like you have to manage around it, that matters a lot. So here's the cleaner way to think about all of this. Stop asking which product is better. Start asking what job your cash needs to do. That one shift clears up almost everything. If this is operating cash or money, you may need to move around regularly. A money market fund often makes more sense. If this is strategic cash, meaning larger idle cash, dry powder, or reserve money, you're intentionally managing inside a brokerage account. SGOV may be the better fit. And if this is true emergency cash, the answer may not even be all or nothing. That's another place people get tripped up. They assume one tool has to do everything. It doesn't. You can split the job. You can keep immediate access cash in the most frictionless place possible, then keep another portion of reserve cash in SGOV if treasury exposure tax treatment, or a little more yield efficiency matters for that bucket. That's usually the more grown-up way to do it. Not because it's fancy, but because it matches the tool to the job. That's really the whole point. This is not about winning a yield contest. It's about building a cash system you can actually trust. Personal finance works better when each dollar has a role. Not every dollar of cash needs to live in the same place. And once you accept that the SGOV versus money market question gets a whole lot easier. So, if you're deciding between the two, don't start with yield. Start with purpose. Ask what this cash is for. Ask how quickly you may need it. Ask how much simplicity matters to you. Ask whether taxes change the math in a meaningful way. And most importantly, ask whether the system will still make sense when life stops being convenient. Because the best cash setup is not the one that looks smartest on paper. It's the one you'll actually use the right way. That's the difference between a clever move and a durable system. And durable systems win over time.